Watch this wick inside the opening range gap, showing a willingness or an unwillingness to trade down into this 5-minute fair value gap or BISI. And then the likeliness to expand higher back into equilibrium or the midnight opening price, small pool of buy side above this 8:50 a.m. high. So I'm watching that. On a 1 minute, other than this order block, so I'm watching that order block. And the best way to measure an order block, in my opinion, I use order blocks as measurements. So this is not necessarily a trade idea, but we can use it to measure the market, see whether we're onside, offside, how the market wants to move. Right now we're inside this opening range, so I do think that we're likely to expand outside of it. I favor higher, like I said, up into the equilibrium. And because we have went below this previous week high, which is liquidity, the function, or when we're above the market and we trade down into it, this was initially buy side, but now it's being used as sell side. So because we went down below it and traded up, creating this 5-minute fair value gap BISI, my interest would be to see it remain open. My interest would be to see it remain open by the time it trades up here into equilibrium. This is my first target. Then I would put another sell limit over here and last one over here. But that's just for ideas. Nothing really going on right now in terms of button pushing. we have fair value right here, this little range. I would allow it to trade down in there, although any closing price obviously below this low negates the idea for me. So notice I don't need it to come back here, and I also don't need it not to, but I am building an expectation around this level of all the possibilities that could play out, and what negates the idea for me and what keeps me in. So that's really all it's being used for. These levels right here, like the new day opening gap, they're always there every Monday, every Tuesday, Wednesday, and Thursday. It's always there. Study how it delivers inside of this, meaning does it stop at consequent encroachment? It didn't stop at the low, but it could have wicked up into it by a tick. You know, there's so many possibilities. It can go to the high and just deliver a tick outside, mohawk it, reverse, and those are things you want to keep logged in your journal. Okay, that's so embarrassing. Those are things you want to keep logged in your journal because soon in time you'll probably run into it again, and if you don't have anything, you know, helping you out or kind of telling you about past experience, it's going to be hard to avoid it. But look at this little wick. So now we have to measure the willingness of it to trade above this. What are the chances that any buy side above this high, people who have went short on just this candle, what are the chances of it continuing down, and what are the chances of it continuing up? This is something that just you get from tape reading experience. And if it were to go down, how far can it go? Well, we have this right here. If we see a closing price below it, that negates the idea. If it closes anything above 46.72, that keeps you in the idea. The idea of it panning out is still possible, but if it closes below, that negates the idea for me. And although it could still pan out, I like to keep it as a rule of thumb. But back to the idea of what are the chances that this is used as buy-side liquidity. Visually over here, I see a small pool of sell side. 1 low, 2 low, 3, 4, and these two are equal, these two are equal. It is possible that they run it study that level as inversion. So, meaning it goes to it and through it and starts to treat it as support now, building higher prices, treating this as a buy-side liquidity pool. I'd like to see this traded too with speed and efficiency, just because of the fact that it's probably one of the first smaller retracements easily trapping retail traders. So there's probably people going short on these candles, and they're likely to be reversed on, and if they were to do it, I would like to see them do it fast. Note the dollar here, how it's just started to leave its new day opening gap, and that should be marked by your 6 p.m. Give me 1 second actually. Your 6 p.m. closing price and your 7 p.m. opening. And let's say that if this were to reverse on me, we know that the base origin of the position was here at 46.71 and a quarter. So plus 5 handles, that gives you 76 and a quarter, which price is at right now. So assuming we were in a trade, that's a good opportunity to cut the trade, just to build experience and kind of bag your profits, but we are not in a trade, sorry, and we're just tape reading this. I can't place any more emphasis on that. But like I said, I'd like to see that higher rammed. Now how we close here is important to me, so I'm going to watch how we close. And also note this order block right here, from this high to this low, all of this was just used as time distortion. So the best way to think of this is, after we took out this high, we had 1, I'll count this one, 2, 3, 4, and 5 candles before we started to return back into the normal delivery of higher prices, aiming for that equilibrium. So the way I'm like kind of looking at this is that this whole entire range from high to low was used as time distortion, which is an order block, and specifically dialing down into this candle right here. That is the opening of this full fractal piece order block. And you would think of this, you know, anything above this blue line in this fractal as the wick, and you could think of anything below this closing as also the wick. So kind of have to imagine it in your head. There's no time frame for that. But you see how it went up above it, failure to trade above this high, so nothing has changed until we trade above this high. Then we have this candle going above its high. So now that order block has been quote unquote validated, and on this candle we didn't come back down, but we don't need it to. So this candle is good enough, and just the idea of it is enough to hold the trade, meaning you don't have to buy every single PD array or pyramid every single PD array. You can just use it as measurements, and it honestly proves to be much more helpful in my own experience. So we closed above that new day opening gap. So I'm watching how we deliver into the equilibrium, and next the midnight opening price, and possibly this buy side pool that would just completely close out the idea for me. That's 3 PD arrays inside a premium, by the way. Expect to see some retracement back into the ranges. You have to be ready to go through that when you're holding for more than 5 handles. Every once in a while you'll get a quick handle, 10 handle delivery, but most occasions it's gonna have to pull back into the range, and it might be a little uncomfortable for you at the moment, but like ICT says, that's why you graduate from 3 to 5 to 10 to 15 and on. So that's one huge piece to the puzzle. There's your equilibrium of the range. Next is the midnight opening price. So you would just, me personally, I would have a sell limit here, sell limit here, sell limit here, and if I haven't mentioned already, after 5 handles, either you're out of the trade or your stop is at break even or better. So that's a non-negotiable for me. Whether it comes back down and stops you at break even, that's not something you can get mad about when it's a non-negotiable. So that's something you've already considered in most of your trades. But obviously you can be raising your stop throughout this at reasonable levels. And when we were down here trading into this, I said I didn't want to see a close below this candle. Sorry, close below this BISI. Think about what that means. It means that it can come down in here, it can come down in here, it can come down all the way here. But if it closes up here, that still keeps me in the trade idea. So in terms of probabilities, in terms of probabilities, that keeps you at a point where if you are wanting to see the trade pan out and you're also wanting to be in a position where you cut risk early, or you're trying to catch your trade before it flips on you, anything like that, it's just a good measure to watch these candlestick closes. And so, like I was saying, we were watching the close below this this low, I think it was, I said, yeah, 46.72 and a quarter. So any closing price below this low, and the idea would have been negated. Now for your stop should have been, for me personally, sorry, anything of 5 handles. So 5 handles, no more than 5 handles, and no less than 5 handles. So it's just always 5 handles for me. It's a constant, keeps all the stress out of it. 5 handles, or I'm not trading it. So that would leave me, I'm just gonna do this real quick, all the way over here. So the way that this would look for me, and while this pans out, the way that this would look for me is right when we traded at the 5 handle threshold, which was right here. So right here, my stop goes to break even, like this. So I'm now in a position where even if it does come down here, only if it comes back all the way down here to the break-even price, then only am I stopped out. Let's say it closes just right here at 46.72, I can manually exit the trade, probably having 1 or 2 ticks of profit, which is basically break-even or better. So once we see the willingness to trade away from this sell side pool, and we see this inversion, which I pointed out to you in real time, same with this order block, once we see the willingness for things to get moving and go back higher, we can move our stop somewhere where we know or we expect for the market not to return if price is bullish. So right there. So we've basically locked in 2 handles. And now, if the market does come back here, all the way down, then you would be stopped out at 2 handles. But we've maximized this trade at 5 handles. And did it reach 10 is the real question. So that would be 46.81 and a quarter. No. quick little thing. The way I look at the market is if the market delivers 4.75 handles from a low of a fair value gap like this, if this delivered 4.75 handles and switched, reversed, and were to not pan out that full 5 handle move, that is not a successful trade for me, or that would not be written as a successful trade in a backtesting journal for me. So I would have to see most of the times the full 5 or even a tick above the 5 to log it as a successful trade. And I use 5 handles, 10 handles, 15 handles, and 20 handles as measurements. So I'm actually measuring from this order block like this. Oops, wrong thing. So 5 right here. So we measured that 10 right here and 15 all the way up there. And honestly, it's a very, very simple thing, but it helps me keep expectations in the marketplace and not aiming too far, but also not aiming too low, which is possible. Just one tick above it, that's all I need to qualify that. And notice how we've already traded above this high. So just as a rule of thumb, or something to keep in mind, even though you might be trading with only one contract or one micro or one mini, and let's say you're looking to full pull at 10 handles because you've graduated from 5, you wouldn't be wrong to scale above this high at all, because it could 100% go up in there and just reverse, and that's not something that you wanna be in and have to look back after and regret. Now, is it the worst thing? No. Can you handle it? Yes. But sometimes it's a better feeling, and it's just better in the long run to be scaling above old highs and old lows, because you could avoid some pretty hurtful experiences. But there's your one tick above and some more up into that buy side, as mentioned, all the way down here, which was at 10:03 a.m. all the way to 10:40. So think about it like this. Where is it? There it is. So that's your inception. And if you want to use this, you can. But you can use this as your inception. You can use this as your inception. I'm going to elect to use this one to just be a little more precise, because this is exactly where I call the market. And let's say you had that buy side pool in mind over here, right? You can use this as an implied dealing range, just like we did right over here on the 5-minute chart. So we're using an implied dealing range inside of an implied dealing range, using the opening range gap as your reasoning for price to want to move outside. We don't know yet where, but we can slowly build up a bias, right? And I had said I'd like to see it trade up to the equilibrium and the midnight opening price, and then this buy side, and that's exactly what we did. And all I did was measure these candlesticks. What they provided to me, I used it, and I used the logic provided with it by ICT. So let's see. Let's just say we were using this as our implied dealing range. The rules for this, and the very basic rules, is 0.5% is equilibrium, below is discount, and above is premium. So you buy at discount, sell at premium. Let's say you want to buy this BISI. Okay, you can go ahead, because it's below the 0.5%. Let's say you want to buy this inversion, or you want a turtle soup sell, because I did mention the sell side, remember? That you can turtle soup buy that, and you can use this order block as a measurement of how do we deliver inside this order block, right? 1, 2, 3, 4, right? And the 5th candle just happened to be the candle that broke the time distortion high, keeping this time distortion low safe. And what made me have more confidence into this is the 1-minute BISI. because it came down straight into it, touched the high, continued higher, treating this as inversion, and this candle, all of these things combined together, everything I'm outlining, even this 5-minute wick, seeing that as inversion, right? How I elected this order block is because of the closing price of it. We closed above that consequent encroachment, so that the market is showing a willingness to want to go higher. And what did it do? It traded above it, right? This candle, 1, 2, boom, send it higher. Imbalance here, come down into it, trade into the high, inversion here, grab sell side, continue to trade higher, all using this higher time frame order block or time distortion. Send it once here, engineer sell side or buy side liquidity, and then run it after a consolidation, which retail is probably going to think of this as a flag or whatever, those flagpole patterns. And that's where I would call it a day. We don't need anything else. We're not looking for it to deliver back up into this high or this high. None of that. We don't need that right now. We can come back tomorrow when the market has quote-unquote reset and we're back in the 10 a.m. hour, or the opening of the 10 a.m. hour, and volatility is to our advantage. But just this idea right here brings suspicion into my continuation of higher prices. So this is not something I subscribe to, but you kind of do see it right there. So that is like suspect to me, and I think it's like a phantom, trendline phantom, or flag breakout phantom. I'm not too sure. I don't really keep up with all of that, but I think that is a good live stream. So I'm gonna end it here, and I hope you liked my message that I sent out this morning. Good luck. And if you saw this, if you saw this today and you're still wanting to push the button, or you feel like you need to buy, even if you are right at the end of the day, I would suggest don't push any more buttons, and instead journal this experience that I basically handheld you with. Journal it as yours and find out what's unique to you. What did you like inside of this run? Maybe you could have traded this immediate rebalance down here and done a much better job than me. Starting my position from here, starting my idea from here. So lots of options. Everything is possible. You could have cut these lows. Do you need to? No.